Let me make sure that the sound input is going through. All right. Looks like the audio should be working now, hopefully. Let me check the OBS. Press 1 in the chat if y'all can hear me, and we'll get started with today's live session. Hopefully y'all are having a great bearish morning this morning. We had some data coming out. Thank you, Martin, for the 1 in the chat. So we had some data coming out this morning. Oh, God. My keyboard is not typed in. So if we go over to the economic calendar and see what's going on, I'll link this in the chat for everybody. Here we go. Thank you for the ones, everybody. Leave a like on the video too. Would be nice. But we had GDP, which came in at 3.2 versus 2.9 expected. So about 10% higher than what the analyst had predicted. So that means that right now the economy is doing very hot, very similar to what we saw in the latest consumer expectations or consumer sentiment report yesterday. We saw that coming in significantly above. So definitely looks like the economy is doing good for right now, given all the money that's still kind of left in the system, right? But as the Fed continues to tighten the monetary policy, that is going to inevitably start to slow down. And you really won't feel the full effects of the tightening cycle until a year after the Fed started to raise their rate. So we won't feel really the full effects of the first interest rate hikes back in March until March of next year. And that was only like a 50 basis point move. And the reason for that is because it takes the markets a while to adjust, right? If you really think about it, whenever the Fed is raising interest rates, the day that they decide to raise rates, you're not just going to go out and take out a loan, right? So if the Fed raises interest rates, are you just going to go out and buy a vehicle that very day? Probably not, right? So people need to it takes people time to refinance vehicles and other kinds of debt, homes, because it's not necessary all the time immediately, right? So with the higher interest rates, people can't afford as much car. We've talked about this a couple of times. But with the interest rate going from 4% to 7%, if you look at, say, a auto loan calculator, I think interest rates for cars were probably at like 3%, honestly. But now, the last time that I looked, it's about 7. If you're looking at a used vehicle, that is. New vehicles, you will generally get a lower interest rate because you are, taking on a higher price for it. So let's see. I'm not really sure what the going rate is right now for a new vehicle interest rate, but I guess I do have a proxy with my sister-in-law recently buying one, and I think it was 4.5. I think that this might be actually right. So let's say that you buy, I don't know, a higher end vehicle, something like $40,000. You're spending $40,000 on a vehicle. Something like I don't know if you can afford it, a Model 3. Let's do standard 60. But the interest rates on used vehicles used to be like 2%. And now it's 4.5. So right now, if we calculate this, you're paying a monthly payment of, well, I guess it doesn't give the monthly payment. You're paying a monthly payment of $380 for, this is not how I want it structured at all. Okay. Total of the payments, so we can just divide this by 60. 39,150. I don't know why it doesn't do that automatically. 60. You're paying $650 a month versus before, if you had finances at 2%, maybe even below that, Total cost us $36.8. You would be paying $613. So you're paying an extra $50 a month just in interest payments alone. And you can really apply this to more, expensive vehicles, especially if you're looking at buying like an SUV. Like an SUV is easily going to cost you like $50,000, $60,000 at this point, right? So we have inflation, obviously, rising the prices of these goods because there's more money to buy less amount of goods or the same amount of goods. And then you have these interest rates compounding that effect of not having enough buying power for consumers. So overall, the economy is doing really well right now, given that there's still a lot of, money in the system. But as the Fed starts to continue, or as they continue to raise interest rates and the interest rates start to be actually effective after about a year or so, you're going to see the economy starting to slow down. But looks like FedEx is actually doing pretty well this morning. I opened a put debit spread on it that's expiring tomorrow, the 23rd. Interesting to see that they're going up while SPY is going down. I wonder if it's a fake out or if that's actually going to play out well. Today, SPY is trading at 382, currently down 1.1% from yesterday's close. And I just looked at the GDP. Let me check out the other data that came out. There's also the jobless claims, which came in higher than just below expectations, but not significantly below what it was the previous week. So we're not seeing a lot of slowdown and, or I guess we're not seeing not really seeing much change in general for jobless claims. And we still have a lot of jobs that are available, per the number of people that don't have a job, which means that people can negotiate higher wages, which leads to wage inflation and overall spending inflation too. But let's see. Real consumer spending was up 2.3% quarter over quarter. PCE prices, that's not actual PCE like the inflation measure that the Fed uses. It's slightly different. Actually, I guess it's a quarterly reading, and then tomorrow we get the monthly reading, so I guess that's why it gets less significance. Interesting. But, yeah, that's what's going on this morning, why we're crashing. Decent bit. The initial jobless claims is what I should have looked at instead of the continuing. Is 216 versus 214 last month, so slightly more jobless claims this month than previously, but not that much more significant. Definitely seems like we're selling off pretty harsh. Might want to take, I don't know, we're down 1.2% right now already. The VIX is trading at 21. If we divide the VIX by 16, this is the rule of 16. There's about a 1 in 3 chance that we end up bouncing from where we're trading right now, or sorry, 2 in 3 chance that we end up bouncing from where we're at right now based on the VIX and the rule of 16. Let's see though. Yesterday was obviously a very volatile day, so that increases the odds of today being less volatile. But given that we do have, these major economic data releases, I do think that it's possible that we go below where we're trading at the moment. And also given that we had such a good rally the last couple of days, that also increases the likelihood. So kind of split on this bearish bullish assumption, but I think, let's see, I think I'll take the bears today. I'll join the bear club. But basically, the reasoning behind this was that GDP came in a lot higher than what was expected, which means that there's a lot of inflationary pressures with people spending more money. And then the jobless claims was kind of just the same as it was previously. So I think if we want to be conservative with it, honestly, we could just do a call credit spread and play it very safe. I think that might be the best plan of action. And I assume I don't know. I'm kind of hesitant to say that we'll stay below the open at 383, given that we're trading so close right now. But I think 384, maybe 385 should be a pretty safe call. So that's exactly when the market started selling off after the GDP report at 8:30 this morning. So the initial candle, we went from 385.07 at open. We closed at 384.49. Divide that by 2, and you get an average of 384.78. So this is going to be my mark to close out of this trade, just in case, the initial reaction basically was wrong to GDP and the jobless claims coming out. So let me create an alert at 384.78, at or above that, obviously. And I think we're going to stay below 385. So I'm going to open a call credit spread. I'm actually just going to do it on my phone. That might be the easiest route instead of having to do it here, and I'll post it on the premium Discord. But yeah, call credit spread, assuming we're going to be under 385. I think this is a fairly decent trade. I'm not sure how much credit that I'm going to get yet, so let's judge it based on that. If we do 385, 386, the credit is it's only $9, so it's not the best risk reward. You're taking on a 9-to-1 risk reward ratio. We could wait for the market to rebound a little bit. Maybe we can use this open candle as a resistance. 383.05. Closed at 381.76. Divided by 2, you get 382.41. So we'll change this mark to 382.41. We could assume that it's going to stay below that level, but I'm less confident in that, obviously, than saying that it'll be below 385. So if I do decide to take that trade on and say do a 383, 384 call credit spread, I would put on significantly less risk for it. Is tomorrow the last trading day of the week? Yes, it should be. Tomorrow is Friday. Today is Thursday. But let's see. The 383, 384. The credit for that is actually like double what the 385 is. More than double, actually. Almost triple what it is. So RR, risk reward ratio, is a lot better, but you are taking the chance of, SPY recovering what it's lost so far this morning since 9:30. Unless, the reaction is really that bad. I don't know if I see it as that bad. I do think that the GDP report was pretty bad news, given that that's just leading to higher inflation. But let's see. This trade... Oh, it's already headed down. So looks like we're probably just going to keep selling off from here. So I'll have to take a lower credit. This trade I'd probably be willing to risk 600 for. Actually, I don't know. I want to make 600 out of it, not lose 600 out of it. So I'm actually going to open 30 of these spreads. And then I want to cut my losses if we hit 382.41. That will be my exit target. And I got filled. Thank the Lord Jesus. All right. Surprised that Robinhood actually filled me. New options alert. P1F. All right. Just opened a new SPY called Credit Spread. That one expires today, so it's going to be a day trade, 12/22. Strike prices 382. Actually, sorry, 33334. Okay. Day trade. So the analysis for this one again. GDP came in significantly higher than expected, which likely means higher inflation and more tightening needed for the financial system. Let's actually look at the 10-year treasury rate is down after this report. Let me see the immediate reaction to it. But the 10-year treasury yield has been rising a lot the last couple of days, if I remember correctly. Yeah. 2 gap ups, so it's kind of just trading flat for the day. GDP came in significantly higher, which means higher inflation and more tightening needed for the financial system. SPY likely to trade below today's VIX expected move under negative 1.3% after bad GDP data and what's called muted jobless claims. So we had a bad report and a neutral report, so overall very bad sentiment that was set by this morning's economic reports. And this is kind of what I thrive on, is these econ reports and macro trading, rather than obviously getting murdered by both Nike and now it seems like FedEx. Still hanging in there somehow with the rest of the market dropping today. My assumption is that it'll stay below, or that it'll go below 167.50, and it's not far from it. But with it kind of defying gravity and beating the rest of the market, it does make me a bit concerned. And then tomorrow, let's see what we have on the economic calendar. Core durable goods, PCE prices, that's definitely going to be a big event for tomorrow at 8:30 in the morning. Then you get the Michigan economic report, my favorite report, but doesn't have a lot of weight to it, even though I like it a lot. Markets don't care what I like. Anyway, SPY's trading at 381.11, so the put credit spreads, or call credit spreads, I'm sorry, that I opened are probably doing pretty well. FedEx not doing so well. Currently down 174 for the FedEx trade. I only spent 300 on it, so I'm not super duper worried about it. And if the markets keep coming down tomorrow with the PCE coming out, if that sends the markets down, that would bring FedEx down, but this does expire tomorrow too, and generally I don't like to hold options into expiration because options are very binary to where you're either going to take max profit or make max loss. That's especially the case whenever it comes to spread options. So I try to avoid expiration if I can. This one just seems a bit harder. We could roll the option over, so close the current strategy that we have to roll it to next week. Let's see how much that would cost us. So if we try to close this right now, the bid is 29, the ask is 73. I'd imagine we can close this probably for 55 if I had to guess. So that means that we're getting $55 in credit, but how much would it cost us to open next week's expiration is the question. Same strike prices as the ones that I would use. I would buy the 170, sell the 167.5, and the total cost for that is saying 109. So I'd be getting, let's see, I would be getting $55 in credit to spend another $75. So my overall added cost for this would be 20 cents each. Generally, how far do I go out with a credit spread? Usually, like, most of the time, like, same day expiration, so 0 DTE. Or if it's an earnings trade, then I'll set it for the end of the week, unless it's like a Thursday earnings report. So if they're reporting earnings on Thursday, I try to set it for the week after. That way I give myself that extra week of time and I don't have to deal with expiration. But let's see. I already paid $115 to open these. Right? So if I extend the expiration day, I'd be adding on another I'd be adding on another 20 cents each in cost. So I'd be getting these for $135. It is a $250 spread, so $250 minus $135 still means that I can make $115. So there's still a decent opportunity to be had with this FedEx trade. And I think that's probably the best course of action for this one. So I'm going to close it and then roll it. You do have to do it separately with Robinhood, unfortunately. Let's see. We could probably close it at 55 if I try. We'll see if that actually happens. Yes. We actually got 177 total. So let me put this in the trade alerts. And I'll type in closing option and also rolling. Closing options alerts. Just cut losses on the FedEx 170, 167.5. Put debit spread. That one expires tomorrow, 12/23. And I close those at 177 over 3 is a total of 59 each. Rolling, same expiration or same strike prices into next week's expiration. So now to roll the strategy, I guess y'all get a little bit of a lesson here on how to roll spread options. You close that one first, and now we're going to open the same one just for next week's expiration date on the 30th. You buy the 170, sell the 167.50, so that's the same thing that I did before, but it was just this week's expiration date on the 23rd. So, rolling this position, looks like the costs went up a lot, actually. To 93, we'll probably have to try to open them at 95. Which sucks, but oh, we got a better price. We got $268 for 3 of them. So a new options alert, premium 101 premium just opened a new FedEx put debit spread. This one expires next week, 12/30 at 268 over 3. Comes in at 89 cents a piece, so we got them at a decent value compared to what the mid price was, at least. 170 over 167.5. All right. Thinking that the markets will come down tomorrow with the inflation report, which should bring FedEx with it, but today SPY has fallen 1.3 and FedEx is still up positive 0.9%. And again, my analysis for this was that their earnings was good. If you look at the Wall Street estimates, it was definitely a beat. But if you look at past year's performance, this was not a good report. This was 318 cent earnings per share. If you look at a year ago, it was 483. So this is down like 20 or 30% year over year, which is not great. Obviously, like their valuation has come down from 319 to 171, so it is down 171 over 319. One minus that, it's like 47%. But I don't know. It's kind of hard to say that it's gonna keep defying gravity and beating the market, especially over a course of a couple days. Seems very unlikely, but we'll see. We'll see how this shakes out. But we got that new expiration date. Let's check on the call credit spread that I had open. Looks like they're down at the moment, $60. So SPY must have ended up recovering a little bit. Still not very close to the 383 strike that I chose, but it is down 1.26% versus the 1.3 something percent that I was down earlier. So that 0.03% really makes a difference. Let's see. It does seem to be catching a balance almost. So holding above 381.17 at the moment. So this will probably be a new support-ish. We'll call it 381.15 because the markets generally like rounder numbers. So 381.15 is where it's catching the support right now. It dipped below it a little bit, but then it ended up recovering. So we'll keep an eye on that price level. I have 382.41. I think that comes from this open candle. So this is the average between the open and the close of the first candle. Candle of significance is what I like to call it. That'll be the first resistance level, and then the next would probably be the opening price at 383. Is a put credit spread good for right now? RSI is oversold. I don't really look at I don't personally look at RSI, but we can bring that up. Let's see. I'll pull up RSI and MACD. So these are the most common indicators that people use. But the problem is just because a stock is oversold doesn't mean that it can't continue to be oversold. So if we look at where it started to get oversold, which was right here after the GDP report came out, if you had opened a put credit spread, then obviously like you would be losing money as RSI has continued to be oversold. So RSI is I see RSI as more of a sentiment indicator than an indicator to either buy or sell or take on whatever position, right? So the way that it works, the way that I see it at least, Some people might see it differently. If you see it in a different way, please let me know in the comments. I would love to discuss it a bit more, but the way that I see it is that if RSI is below 50, 50, I like to make this, and then I like to get rid of the show price or whatever, and then extend it to the left. Looks like we just sold off a bit more, but let me just make it as clean as I can. So whenever this is below 50, this is bearish, right? So I see it more as a indicator for bullish, bearish, or neutral. Yeah, this is Thinkorswim. Let me try to get rid of my MACD so we can just focus on RSI, and I'll try to explain it the best that I can. So let's get rid of MACD, just have RSI up. So anytime that this is below 50, between 50 and 30, it's bearish, right? So we crossed below 50 right around 12 a.m. It's what it seemed like. And ever since then, it's been trading below 50 RSI, and that's been bearish for the overall market, right? But whenever this is above 50, like it was during this period right here, pretty much all day yesterday, this was bullish for the market. So the market went up by 1.3% or whatever it was yesterday. So this is how I use RSI whenever I decide to use it. But it's more of an indicator to determine sentiment than it is an indicator to tell if a stock is overbought or oversold. You can stay in this oversold territory for a prolonged period of time. Yes. I wouldn't say that they're worthless in this market, but they can give you an idea of sentiment rather than whether or not you should take on a specific trade. The way that I would see it is, as long as we're trading below 50 RSI, the stock market will continue to be bearish, so I would take on bearish trades accordingly. And then if we go above 50 RSI, then I would probably want to consider closing out of my bearish trades. But there are overreactions. I'll show you a couple of overreactions. So this was bullish, right? So the market was above 50 RSI pretty much all of yesterday, but then at one point it ended up dipping to 47, okay? But then it still ended up, rallying after that, right? So that was an overreaction for RSI to go below 50, but overall it was a very bullish day. If you had bought a put option just because RSI dipped right below 50 for a second or, for 10 minutes, then that bearish trade wouldn't have worked out for you. Yeah, no problem. Cool Coke. Those call credit spreads are now going for 16 cents a piece. I opened them for 22, so we're up $180 for this trade so far. I mean, this is a pretty rough sell-off. I would say, like you said, we are oversold. But I would avoid put credit spreads. So what I probably would have done this morning, what probably would have been a better idea, obviously 20 or hindsight is 2020. But what I would have done probably is opened a put debit spread, assuming that we would continue to be oversold and that we would have an even worse sell-off. So if I had been, more attentive at the open, then I probably would have opened a put debit spread, probably assuming that we would be one or two strike prices below where we opened at 383, right? And that probably would have made you a crap ton of money. Obviously, hindsight is 2020. I can say, oh, I could have made this amount of money, or I could have made this amount of money, and it's really all about actually putting in the work and making the money. But that's why we opened the call credit spread, right? So we're assuming that SPY is going to continue to be bearish, but there is, the potential of coming back to maybe 50 RSI to being neutral later on today. So that's why we opened a call credit spread. Since we got in a little bit late, that also reduced my confidence too. But that's why I opened a call credit spread instead of opening a put debit spread. Yeah, price action is the number one most important thing. Volume and price. So basically, supply and demand is the only thing that really matters. Like throughout every facet of the economy and the stock market, in terms of good prices and inflation, supply and demand are the only thing that dictate prices. But obviously, supply and demand are controlled in different ways through raising interest rates to destroy demand or more infrastructure spending to increase supply. I kind of wish we had that instead of the spending package that we have at $1.7 trillion, but we won't get too political here. Let's see. The VIX is trading at 21 now, so that's up 5%. UVIXI itself is up by 2%. So UVIXI is supposed to do 1.5 times whatever the VIX does. And I think, let's see, the shares that I bought yesterday. So I bought another 50 shares. So I have, or 60 shares. So I have 310 shares of UVIXI at an average cost of $7.52. I wonder if we should shorten the time frame of how often we're buying the VIX just because of the time decay that comes with it. Instead of buying once a week, like dollar cost averaging once a week, maybe we should do this on a daily basis and reduce the amount of money that we're spending on each buy, potentially. So if we divide 400 that I want to spend each week buying UVIXI by 5, I would spend about $80 a day buying UVIXI. That is a possibility. I already did spend $400 yesterday, but I still kind of want to buy it. I still think the VIX cycle is likely to play out. So I showed this in yesterday's live stream, but if you look at the yearly chart for the VIX, let me get rid of the studies. Remove all studies, please. If you look at the VIX, it looks like it bounced again. So I guess we either... No, it doesn't seem like we had a shortened cycle, but the average cycle is about 3 months is what I found. 2 to 3 months, and we just started the cycle in the beginning of December. So far into the cycle, we're let's see. Well, I guess if we started December, today is the 22nd, we're 3 weeks into the cycle. So maybe we peak later in the cycle in like week 6 to 8, similar to what we saw back in March of 2020, whenever the Fed started to tighten. That is a possibility. Now that recession fears are kind of hitting the market, maybe that's the new kind of spike in volatility that we're going to experience based on fears of a recession next year, just continuously increasing. It's what it seems like. So I think I'm going to buy $100 worth of the VIX. And I'm going to do this on a daily basis rather than $400 a week. So I'm actually spending $500 a week, I guess, but that's okay. So $100 a day keeps Fed Chair Powell away. Oh, man. Okay. So this is going to be a buy alert for the Patreons. Buy alert. Just bought $100 UVIXI at $7.02 per share. So now I have a total of 324 shares at an average cost of 750. And I'm just going to keep adding to this position until we're towards the end of the 3-month cycle. Looking, starting to DCA, dollar cost average, $100 per day, until week 6 to 8 of the 2 to 3 month cycle for VIX. So it's very cyclical. You know, it just basically goes back and forth on the average. And for the average this year, it's probably, I guess we can actually look at the average by pulling up how many trading days are there? There's 252 trading days, so we could pull up a 252 simple moving average. Moving average. Simple moving average. And then we change the settings to 252. I think there's 252 trading days. Let me see. Let me just double check. How many trading days in a year? 252. That's what I thought. Square root of 16 of the rule of VIX. That's how I remember it. 252 though. Hopefully it works. Yeah. So the average price over the last year for the VIX has been 25.5. And I think it's likely to go back to that. Maybe we can create a price alert with the moving average. No, it doesn't look like we can. That sucks. I wish that they had that kind of alert system to where you could set an alert based on studies. If anybody knows how to do that, please hit me up. I'd love to figure that out, but anyway, let's get rid of that moving average now. We know the price is 25. The average price over the last year has been 25.50. So we can just set a price level accordingly and call that an alert. Create an alert at 25.5. Obviously, the moving average can change with pricing, current prices moving around. But TradingView, it's pretty easy to do that. Yeah, I know TradingView is pretty OP, overpowered. I like TradingView a lot. I just don't want to pay the extra like $30 a month for it. I'm a very cheap person. I will not pay for anything that I don't 1000% need. Robinhood they have price alerts, but I don't think that they have moving average price alerts. Let me see. Let's advanced. $252. Okay, so we have the chart. Meh. Where the heck is... How do we set price alerts on here? I've done it on my phone. I'm actually moving away from Robinhood, though. I've decided to actually move my money over to E-Trade because Robinhood keeps eating my freaking money with these spread options and the bid-ask. It's so awful. It's under notifications. Notifications. Okay. I mean, if you go to notifications, you get the messages. I really wish that you could just do it from like the stock screen itself, like just go into SPY and being able to, like having a button like right here saying like a little, I don't know, a bell or something like that. You would think that the company that's so good at UI would be able to do that, but yeah, it might just be like the mobile app. Let me see. Because I've definitely seen it on the mobile app, but I'm not seeing it at all here. Yeah, so if you see on the mobile app, let me actually make my screen a bit bigger. They do have that little bell icon, so I guess I'm not original in thinking that idea up. But yeah, that little bell icon right there that you can see. You'd click on that, and then price moves above or below, but you can only set price targets for it. So you can't do like moving averages and stuff like that. Anyway, let me put my face away. There we go. Head on back to Thinkorswim. How's the jobs report? It was pretty flat, which is kind of bad. Like, you would want to see more jobs being taken away, and as bad as that sounds, but that decreases the money supply in order to get inflation down. But the jobs report came in basically what it was the week previous, so it was like neutral, but also kind of bearish. Was it much better? I think it was the same, basically, if I remember right. But let me... Not economics.mit. That's not what I need. Maybe they're trying to give me a hint. Go back to school. What date do you choose for your call spread? Today. Today's expiration. It's already up by 360. So you don't get the risk-reward ratio that I initially got on it. Looks like the put debit spread for FedEx is still not doing well. They're still up 1% with the market falling 1.6. That is insane. But yeah, I opened these spreads for like 22 cents a piece, so you're not getting the same 5-to-1 risk reward ratio. Now you're getting a 10-to-1 risk reward ratio. So, not sure if I would open it now. Given how much we've sold off, I would think that unless there's any like good news in the market to change course, I think today's going to be a pretty decent sell-off, and going back to 383 at this point seems pretty unlikely. Obviously, it can always happen. Anything is possible. But I would probably put it between... I'd probably say, honestly, like a 10% estimate. If we do end up turning around like right now, that would definitely increase my estimate to probably like 15%. So I would, for right now, given that we're bouncing a little bit, I would say like 10 to 15. Obviously, I'm not like married to any specific estimate. You want to keep an open mind and changing markets. Like if we ended up losing at $380.40 and went down from there, then that would lower my estimate to probably like 8 to 12% instead of 10 to 15. So you have to be kind of adjustable with the mental probabilities, is what I call it. It sounds like mental gymnastics and a bunch of bullshit, honestly. But that's the way that I trade. That's my style of trading. Whether it's bullshit or not, it works for me. But yeah, I'd say 10 to 15% chance going back up to 383. If we can't make it back to 380, I would say 8 to 12% chance. So we'll give it a little bit more time. Thinkorswim alert book and then study alerts. Let's see. I haven't dived that deep into... You would think that I would dive deeper into Thinkorswim and Robinhood given how much I trade with them, but I don't really explore too much. Maybe that's something I can work on, is exploring the platform a little bit more. But you say Thinkorswim alert book and then study alerts. Alert book. Would that be under tools maybe? No. I wish they had like a search function. That would be very nice. Oh, alerts. There we go. Market watch alerts. Okay. So this is the alert book. That's what I'm assuming. Eric. Mental gymnastics and bullshit. That's the name of the game. Yeah, you got to play the same game that Wall Street is playing. All they do is mental gymnastics and bullshit. Just with some spreadsheets. What's the signal to exit that spread? 382. Just tuning in. My bad. New to options. So my signal to close that would be if we go above 382.42. I set an alert at that price level. So if we go above that, then I would want to close that at a loss. But the hope, what I want to make out of the trade is closing this at 10 cents a piece. Right now it's already going for that at the ask price, so I'm just going to close it now. So definitely wouldn't open it. But I made 390 on this trade, 60%. Pretty decent opportunity this morning, but it's not the same opportunity as it was. So I've been flagged as a pattern day trader. You've placed 4 day trades in the past 5 trading days. To continue trading, you must maintain a portfolio value of at least $25,000. I have $25,000 in my account. Leave me alone, Robinhood. We got like $34,000. Zero commissions. Yeah, but you screw me over on the bid-ask spread. Ugh. Stupid company. Gotta love my beef with Robinhood. Why don't you use Thinkorswim for trading? It's just not a very intuitive platform, from what I've, from what I've seen. I've tried using it before, but there's just a bunch of settings that you have to like adjust, and I don't really care to adjust those settings. To take the time to adjust the setting. New options alert, closing options alert, I should say. Closing options alert, premium 101, premium. Just took and Thinkorswim also doesn't have the best fills either. We'll talk about that on the SPY call credit spread. That one expires today, 12/22, at 257 over 30. We actually got a better price than what we had anticipated. 8.56 a piece. So basically 9 cents each. Okay. All right. So that one we opened for a total credit of 660. Closed it at 257. 660 minus 257. Took a total profit of $400. $403. I like it. I'll take it. Robinhood, you get what you pay for. Exactly. But Thinkorswim too. So Thinkorswim, they charge you a 65-cent commission, but from what I've seen, they basically give the same fills that Robinhood does. So I'm always talking on my premium Discord, and like we're trading together, and I always see the people that use Thinkorswim getting the same prices that I am using Robinhood. So Thinkorswim is charging you 65 cents, but they're not getting you a better fill price. But at least from what I've seen anecdotally, E-Trade has some of the best fills. So I was going through, and I'll actually show it here in the chat. There was a member that basically only uses E-Trade, and they were getting like $2 or $3 better fills. So if we look through this person's history, sorry to call you out, Pat, but let's see. I'll try to find it. But basically, every single trade that this person was taking on, they were getting a $2 or a $3. Do a video comparing fill prices between brokers and expose everybody. Honestly, I mean, I made the video of Aries versus Robinhood. Aries I like because they have zero commission and they generally have a smaller bid-ask spread, but sometimes you won't actually get a fill at the bid or the ask, even if you put in that price. And I kind of got frustrated with that. And, you know, the problem is whenever you're trading spread options, there's less volume on it. Volume going around to, like, facilitate that trade. And with Aries, they are a small broker. So that probably is why it's harder to get filled on Aries. But I'm moving my money over to E-Trade just because of what I've seen from this person. So let's see if I can find their fills. I was able to find them very easy yesterday. I'll just search actually E-Trade. Okay, so I'll show y'all. E-Trade is 65 cents a contract. So they charge you a 65-cent commission each contract, right? So for a spread option, you're opening 2 spreads, which means that it's going to cost you a total of $1.30 to open the spread, and I guess also $1.30 to close the spread, right? So 1.3 times 2, I think it's opening and closing. So you're getting charged a total of $2.60, so I guess you're not actually saving any money in the end. So I guess I might have just played myself. But this person was getting like $2, $3 better fills on each of their spreads than I was able to get. Let's see, like their bid ask was 4 to 8 cents. I forget what mine was. But this trade says they were seeing 9 cents in Robinhood and 7 cents in E-Trade. So they were able to get a $2 better fill using E-Trade than they were able to get with Robinhood. And I think, don't quote me on this, I think if you make enough trades with E-Trade, you can actually have the fee per trade reduced. I'm going to reach out to their customer service, see if that's actually the case. But, I mean, if you're taking on enough trades, then it should pay off if they do reduce the fee. I have a 100% win rate since I joined Aries buff. Honestly, I love Aries, but I called their customer support. I finally got around to calling their customer support yesterday. And turns out that since I am down to $1,000, they took me off of margin, basically, which is why I'm seeing the 90-day restriction. So if you don't have more than $2,000 in this account, this is for every single brokerage. If you don't have more than $2,000, then you can't do spread options because you don't have a margin account. So I think that's why I'm seeing this. I'm going to actually try to make a trade here. So this is Aries. And I think I'm going to start a $1,000 portfolio challenge just for the hell of it, since I'm starting with $9.99.93. And this is probably just going to be a level 2 options account to where I'm just buying calls or buying puts instead of just using spreads, because I know a lot of y'all are probably newer to trading and probably only have level 2 options trading. So that's something that I might be looking to implement as a $1,000 kind of account challenge, just using level 2 options. I've got a couple ideas on how I want to play it, but let's see if we can actually find a decent opportunity. And I'll take y'all actually through how to open a trade on Aries. So it's very Robinhood-esque, very sexy user interface, which is what really appealed me to Aries. And if we go over to, let's say we're going to buy a UVXY call. So our assumption is that UVXY is going to go up in week 6 and 8 of the cycle. Right now we're in week 3 of the cycle. So in 3 weeks or so, UVXY should see a decent climb. So that would be, I'd probably set my expiration date for January 20th or the 27th. I'll call it. Let's see what the difference is. So the 750 strike price is going for 56 on the 20th, and the 750 strike price is 69 for the 27th. So you're paying an extra 69 minus 56, or divided by 56. You're paying an extra 23% for an added week. I don't know if the premium's worth it. But I just want to try to see if I can make a trade with the 90-day restriction thing going on, or if it's just spread options that I can't open. Let me just try this. So my assumption is that UVXY is easily going to go back to the average over the next 4 weeks. So that would be a, let's see, climb of 2140 right now to 2550. 25.5 over 21.4 would be a 19% increase for VIX alone. Now, recently, UVXY has been leveraging by 1.5% for whatever reason. Today, it's actually down less than the VIX is. But it should, theoretically, based on the 1.5 leverage, climb by 28.5%. Now, with the, I don't know what's going on, why it's not tracking 1.5%. But let's say that it goes up the same amount. Actually, let's say that it goes up less than VIX just because of the volatility decay. Or not the volatility decay, the time decay. Let's say that it goes up 18% from where it's at right now. It's trading at 7.1 basically times 1.18. Let's say that it goes up 18%. We would want a call option with a strike price of $8.30, or not a strike price. Call option with a break even of $8.38. So luckily they give us the break even price. Makes it a lot easier to read, and we could buy a $8 call with an $8.45 break even, which is slightly above, or we could just buy the $7.50 call with a break even of $8.05. Currently, this is going for 56. So if we do end up hitting my $8.40 price target, basically, minus the $7.50 strike price, these would be going for around 90 cents a pop, right? So 90 cents over 56, that's about a 60% potential upside. Obviously, I could be wrong, and this could be completely wiped out if this option expires out of money, and if UVXY is below 750 on my expiration date on January 20th, then I lose whatever I pay into this trade. But right now they're going for 56, 57 at the ask. So you can see right here the bid-ask spread is $1 wide, whereas Robinhood, if I'd open this same trade for UVXY, 750 call. Let's see, for January 20th, I think was our expiration date, if I remember right. Yep. This is going for 57. So if we open, it's 56 and 57. So they actually have the same bid-ask spread, surprising enough. So sometimes, the bid-ask spread will be worse than other times. If you open a spread option, that would definitely be the case. So if I opened a 758 call debit spread and then the same thing on Robinhood to where I sold this, now the Robinhood, whereas the bid-ask is 12.12 on Aries, right? So the bid-ask on Robinhood is a lot larger than the bid-ask here on Aries. And that's more so the case whenever it comes to spread options, since you're dealing with two options instead of one. Anyway, let me actually open this trade now that I'm thinking about it. Where I'm buying the 750 call, and I'm assuming UVXY is going to go all the way up to 1.18 times the current price of 710, $8.40 basically. Now we're paying a little bit more in order to open it, but that's okay. There's still opportunity here. What was it? 90 cents difference. 8.4 minus 750. So we still have about 50% upside on this. More than 50% upside. Let's say we open 5 of these. How much will that cost us? That should cost us about 300. What is intelligent? Oh, you can actually route your trades through different brokers. That's interesting. Huh. Wow. I've never seen that done before. Not to Aries horn, but that's pretty cool. So I'm gonna submit. Order failed. 90-day restrict. Yep. God dang it. Okay, I called them yesterday, and he said that I should be able to trade level 2s, but apparently not. Whatever. I'll try to get that fixed today, I guess. Either that or I need to get my account. He said that I just need to get my account balance above 2,000, and then I should get rid of the 90-day restriction. I don't think he knew what he was talking about, honestly, but yeah, that's the end of the trading day for me. 10:37, so we went a little bit over, but thanks for tuning in, everybody. Make sure to leave a like on your way out, and I will catch y'all tomorrow at 9:30. Bye, everyone.